The Fed doesn't seem like it's going to pause. 5.1% is the projected rate for next year. What will that do to the markets?
Yeah, I mean, the Fed is saying they don't want to pause. They've made it clear that they'd like to get another 3 rate hikes in next year. But the data are really clearly slowing, and we see inflation on a 3-month annualized basis. It's down at 3.5% or so. It's only going to slow faster. The Fed can talk and jawbone those expectations higher. They can say we're going to get to 5.1%. But the reality is they've not been very good at predicting where inflation will be. They've not been very good at predicting where rates will go. And so there will come a point early in 2023, we think, where they will simply have to stop hiking and pause. Now, if they keep pushing above 5%, they will cause a recession and inflation will come down very, very rapidly. And I think that's a risk they're aware of, but they just want to prepare the markets for another couple of hikes.
Are you taking a more defensive position right now? You have reduced equity slightly.
We have a little bit, and that's really a reflection of prices pushing higher quite quickly recently and an increasing risk of recession. We still don't think a recession early next year is a base case, but you've got to respect the inverted yield curve, and it's very, very inverted. We know that has historically preceded a recession, so we've got to be thinking towards the end of 2023, early 2024, there's a significant risk of recession. That said, if the data continue to soften, inflation slows, the Fed will not get to 5.1%. They'll probably get to 4.75. In that case, equities could still push higher, but from a risk management perspective right now, with that rally, it's time to just take a little bit off, we think.
What does that mean when it comes to earnings revisions? Is there further to go when it comes to the earnings recession, or could we actually see a surprise to the upside?
In the near term, this has opened up a little bit of scope for an upside surprise. We've seen those earnings expectations ratchet lower. We think we'll see more of that. Now, if we avoid a recession in the first half of next year, and we think the US is likely to avoid it in that first 6 months, there's scope for an upside surprise, and that really does mean you could still get okay returns in equity markets. Of course, with the rally we've seen recently, those returns have already been brought forward a little bit. I think that's being priced in somewhat. So it's not really time to be adding exposure. We think we're quite happy to start moving back towards a more neutral setting from where we are now.
Would you be adding exposure to Chinese equities or other Chinese assets given the pace of reopening?
It's a difficult one because that pace of reopening has surprised everyone with just how quickly they've rolled some of these restrictions back. That does introduce some risk. But when you look at the playbook from the rest of the world, when economies reopen from COVID, there is pent-up demand just waiting to get out there. We think that is going to be the same in China. We would expect over 2023 for China's economy to grow much faster than we've seen this year. It's been a recession this year. It's coming out of recession. There's going to be policy support. We're rolling back COVID. We think Chinese equities could be one of the best performers through 2023. And depending on where you're positioned now, it's a really good time to start looking at that.